The market progression we have witnessed for the last 200 years started in the 19th century. The agrarian economy was ruled by the commodities market. The 20th century, an industrial-based economy, was ruled by the stock market. The 21st century is an information-based economy that's ruled by the forex market. With both the commodities market and the stock market, we buy something, product or commodity, shares in company or service, hold and hope. Then we sell for a profit. What we're really doing is converting cash into an instrument and then waiting for an increase in value. We sell the instrument and convert it back into cash. We are reliant on others, selling if we want to buy, but buying if we want to sell. Regardless of the catalyst, we see the results of this system. It is said that General Motors was the biggest failure of an industrial company in US history. This has been repeated across Europe and Asia. In January of 2010, it was reported that there were now 23 million people unemployed in the Eurozone. The response to this is that governments across the world printed more cash and put it into the economy. For the most part, this money was put into the banking system. Therefore, it is of no surprise that as the stock markets have crashed, the forex market has virtually doubled in size in the last 2 years. Companies that were quick to realize this, like Goldman Sachs, saw bumper quarterly profits. July 2009. It was said the bank had benefited from higher volumes of trading while seeing record revenues from currency and commodity trading during the second quarter. The next quarter, October 2009, saw massive profits, 3 times the earnings from the same period last year. Again, profits were boosted by second successive quarter trading in commodities and currencies. Even the Federal Reserve benefited from the large cash increases. A report from a few years ago from Daimler Chrysler acknowledged that more than half the second quarter operating profit was generated by favorable currency trades, indicating that they had made more money on foreign exchange than they did selling cars. The good news is, it's not just the banks and corporations that are making big money. Here's an article in Canadian Business 2005 that stated day traders are back and the hot new market is foreign exchange. Joanne explains there's a huge river of currency trades flowing past us all the time, and I think of my job as dipping in and taking out a thimbleful. Welcome to Currency Connect, your portal to the world's financial heartbeat. Would like to invite you for the next couple of minutes to investigate the forex market. In 1944, the major Western industrialized nations agreed to pegging to the US dollar. The US dollar in turn was pegged at $35 to the troy ounce of gold. This was known as the gold standard. By 1971, President Nixon abandons the gold standard, directly pegging the major currencies to the US dollar. By 1973, this system was abandoned and the floating rate system was implemented. Because of the floating rate, currencies move up and down in value against each other, mostly as a result of economic announcements. If an economic announcement is given that is good for the American dollar, money will flow into the United States. Tomorrow, an economic announcement may come out that's not so good. Money will flow out of the United States. Economic announcements are the tools that governments use to measure the health of their economies. Here we see the US debt clock. Economic announcements are given out all the time that affect the US economy. Things like gross national product or GDP, oil inventories, unemployment results. Today's global economy revolves around the US dollar, the euro, and the Japanese yen. The other major currencies are the Great British Pound, the Swiss franc, the Australian, and the Canadian dollars. The US dollar is the benchmark currency. When major economic announcements are released, the world reacts. If the US dollar goes down in value, it means that all the currencies against it go up in value. What we wait for is confirmation that the US dollar is trending up or down, and then we react accordingly. Foreign exchange, the forex market, is an electronic network of international banks. It's the world's first electronic exchange. There is no physical location for the forex market, it exists on the internet. Transactions are processed immediately in seconds. Prior to 1998, currency trading was available only to banks and large corporations. Since 1999, due to the advances of internet and software technologies, currency trading becomes available to the general public. Real-time currency charts are now built into the trading stations. Increasingly, vast amounts of foreign currencies began flowing from bank to bank, country to country, continent to continent. According to the Financial Times, daily trading volumes now exceed $3.2 trillion per day. This means it's a level playing field, regardless of account size. We get real-time buy and sell rates. We all get the same information at the same time globally via the internet, as long as you have the software to be able to read it.